All right, thank you, Morgan.
Nice.
So I think we'll start with when people hear the term wealth management, they think of investments, which is primarily what we do, but we also love the challenge of providing personal financial planning and financial literacy education, which is what's brought us here today. And the original plan, when we were approached a couple of months ago, was to talk to you and provide information on creating a budget for when you land that first big job after graduation. And then the pandemic happened. And SUNY ended up shutting down for the remainder of the semester, as you know, and well, you're still learning online. And now we have over 16 million people that are wondering if they can even afford to pay for their rent or mortgage, which makes creating a budget seem kind of irrelevant when the current focus is on survival, both physical and financial. And financial survival to me means knowing your basic necessities. Can include your personal vehicle or public transportation, whatever you use. Health insurance, which is extremely critical, especially right now, and being able to pay your debts. And those student loans are going to start soon enough after graduation, although you have a few different months. So I think with that, we would have had that conversation, ironically, when we would have done this plan to begin with. We would have talked about that because this is all stuff that you need to know once you graduate, because you're going to be out there looking for a job and weighing some job offers. And how would you know what is considered an adequate job offer without knowing what you need to support yourself? So I think all of our conversations kind of start there. And then SUNY approached us to continue on, instead of doing the face-to-face meeting, instead do a Zoom meeting, and we thought that was a great idea. But we agreed that we wanted to open it up to more of a forum style so that we could answer anything that you have that's financially related, any questions, instead of just concentrating on creating a budget. So as Morgan noted, we would love for this to be interactive. You can interrupt us at any time, ask any questions that you have. We can't promise to have the answers, but we can definitely go and look for stuff for you and be happy to contact you later. And we just are excited to be here today, so we thank Morgan and Toby for allowing us this opportunity. And I don't know if you'd like to add anything, Adam.
To touch on trying to keep track of things, use it wisely, trying to plan for your future responsibly. And really right now, it's important, but it does take a backseat to making sure that you have the essentials, making sure that you have things set up to make it through what you need to right now. Really the principles are still important, but we might just need to tweak the plan a little bit.
Yeah, it is just focus on survival at this point. It's kind of amazing. All right, so our first question that we had was, how quickly do benefits, and in parentheses is retirement, start after you are hired? And the answer to that really is that it can vary from company to company. I know here at Clute Wealth Management, how we set it up is that you have to be an employee for a year, and then you can only enter during one of two opening enrollment periods, which for us are January 1st and July 1st of each year. So if you happen to be hired on we'll go with January 2nd. If you're hired on January 2nd, then you won't be able to start it until July 1st of the following year. So it could end up being quite a bit of time before you get to enter it. And I think that most employers tend to do a year. I have heard some are shorter, but you can expect a year. In the meantime, though, that doesn't mean that you can't contribute to your own IRA or Roth, some kind of retirement account for yourself outside of work. And I do want to add one thing to that. A lot of people question if they can start a 401k and just not have the employer portion if there is one, but that is not allowed. It's an all or nothing type of start for the 401k.
Yeah, and when it comes to the employer retirement plans, like Christina said, every one of them is different because they have control depending on what type of retirement plan is. That there's a lot of different types. Basically, in some of them, they have a lot of control. They can be very specific with the different rules they lay out for how you qualify to be part of the plan, and also things like matching contributions, like you may have heard. But the big point there is, don't assume that just because one of your friends or someone that you know has a 401k or a retirement plan, that yours is going to be exactly like theirs. It's very specific to the company, so make sure that you talk with the HR person and get all the information that you can.
I had a follow-up question for that too, just knowing a lot of the students I'm working with. Could you even kind of break down like kind of the basics of what a 401k is and like what a IRA is? Because I'm thinking some of our students might not even know what that is.
Yeah, that's a great question. So let's start with 401ks are usually for-profit organizations, and those are a type of retirement plan that both an individual and an employer, if they choose to, can contribute to it. And then you can contribute more to a 401k than you can to a traditional IRA or Roth. And then I guess you want to get into the difference between an IRA and a Roth?
Sure. So to go along with the 401k piece, there might be things that you see called a 403b. Those are kind of the opposite side of the coin of a 401k. It's a not-for-profit organization. So if you have a school, a hospital, things like that, those type of organizations, it's very similar, a 403b and a 401k. Again, based on the employer. And then there's IRAs. Those are individual to the person. So once you have an IRA, that's yours. You take it wherever you go. You don't have to worry about employer. But the contributions are much smaller than they would be to a 401k or a 403b. You can have money come out of your pocket for an IRA, whereas money comes out of your paycheck for a retirement plan like a 401k or a 403b. And with a traditional IRA, the money comes out pre-tax. So if you put money from your pocket into an IRA, you can get a tax deduction for that. And then the money grows in the IRA. That's the goal. The market does go up and down. But basically, when you take the money out of it, you have to pay taxes on it, similar to how income is taxed. And there's a different option out there that's especially good for young people. It's called a Roth IRA. And what that means is that you put the money in from your pocket and you don't pay tax. You don't pay taxes when you take the money out.
At least not right now.
Yes, the way the rules are written right now, you don't pay taxes when you take the money out. So it could grow and potentially be tax-free for you forever and ever. But you don't get the nice tax deduction when you put the money in. So that's the difference between traditional and Roth, is really how the money's taxed when it's taken out.
And a lot of 401ks and 403bs have a Roth option within the 401k or 403b. So we have that here. You can choose a traditional 401k, which would be all of your money tax deferred. And by the way, as an employer, all of our money goes in tax deferred. It cannot go into the Roth option. So 401ks tends to be a little bit complicated for people to understand, but like Adam said, the biggest difference that you're going to recognize from it from a traditional retirement IRA is that the money's has to come out of your paycheck. You cannot just write a check and send it in. It has to come out of your paycheck. And then 401ks and 403bs have a lot of different rules for, some of them allow loans, some of them don't. Whereas an IRA, you can't get a loan from an IRA, right? So you really need to know what your 401k or 403b is offering as far as a benefit versus what somebody else is. Like you said, a friend, hey, my friend can do that.
Yeah. And one of the big things with any of those accounts, they're considered retirement accounts. The goal is to keep them for the long term until you need money for retirement. So there are certain things built in, like penalties if you take early withdrawals, that they have a tax penalty of 10% if you pull the money out of an IRA before 59 and a half. 401ks have something similar depending on the plan, usually age 55. So the idea that you're putting money in these accounts, you must have that idea that it's for the long term and that you can't just, oh, well, you know, if I ever need it, I can get it. You might have some hurdles to go through to get that money.
So, and with everything, there are caveats. So for the long term, the age is 59 and a half, by the way, is typically when the 10% penalty goes away. But with a 401k, there's also the ability for an employer to add a profit sharing side to that, which means that if the employer believes that they had enough profit that year, then they can make an additional contribution to your retirement account for you, nothing out of your pocket, but often they require that you stay on for a number of years in order to be able to recognize that money as your own. So you could have a significant amount of money going into a 401k or a 403b in any given year. I think this year it's limited to $57,000.
Yes.
And traditional IRAs and traditional Roths are 7,000 if
they are 6,000.
6,000, but 7,000 if you're over 50,
yes,
which
yes.
doesn't apply here.
Yeah.
And then a quick side note that the CARES Act did eliminate this year the penalty for withdrawing from the retirement accounts if you need it and it's you can show that it is COVID-19 based.
I believe there's a $100,000 limit on that,
yeah.
which is a sizable amount.
Yes.
But this kind of gets us into one of the other questions we had, which is, you know, how much should you contribute to your retirement plan when you first start out? So like Christine was talking, employers can, depending on the plan, put money in on your behalf without actually you even putting a dollar in. So sometimes that's the case. So you may be farther ahead than you just putting your own money in to start with. But there's also match options sometimes where the employer will match the percentage of your paycheck up to a certain amount, usually about 3% that you put in. So sometimes if you choose not to put any money in right away, you're kind of giving up the free money that they would offer to match your contribution. So
always take that free money on the table.
So there's a big distinction in how some of the money goes in there, but in a lot of cases, you may be, you know, if you choose not to contribute, you might be leaving money on the table, or you may be getting money put in there on your behalf from your employer. You really have to know some of the ins and outs of the plan that you're dealing with. But to start off, you know, you really have to take a look at what your expenses are. Going back to that basic idea of a budget, you have to figure out what you need to live on. You know, you have to make sure your basic expenses are paid for. And, you know, if you are in a comfortable place, you may find, okay, I have a little bit of extra money that I also have set aside for an emergency fund in case anything happens. You know, my car breaks down, I have a little bit of money to help me through with that. I don't need to put something on the credit card. But also you have a little bit of fun money possibly that, you know, you can go and do something fun. You don't have to just be all work and bills.
Except for right now.
Yes.
There's nobody going anywhere.
In general, yes. Now there's a little bit less, you know, fun activity that's possible. But, you know, really you want to make sure that you can afford your daily life and then worry about contributing to your retirement account.
Now, Morgan, do we have a question from somebody right now? I see the...
Yeah, so actually a question did come in, and it's actually something I was thinking of asking too, but was basically surrounding, you know, and I've experienced this myself, was you start your job and they give you a book of, like we were talking about 401ks and that type of thing. They give you a book of like, here are your options. And then it's like, usually like in my scenario, it kind of felt like, here are your options. You got to pick by the end of the day today. It's like,
yep.
Oh, okay. Like, and I'm just curious, like, advice you would have for, you know, if you get that book from Fidelity or, you know, that your employer has, or your book from TIAA Craft or Prudential, like, and it kind of has all the plans you'd be eligible to contribute to. Is there a suggestion you have in how to like navigate that, or who to get advice from? You know, if you run into that, I guess.
Yeah, that's actually one of the biggest complaints when it comes to retirement accounts through an employer, because there really isn't a lot of guidance out there for people to help them choose what to do. And it's not because the employer doesn't want to provide it. It's really because there are compliance rules in our industry that have to be followed. And so there's a lot of regulation around giving advice to somebody that isn't your client that's paying for your advice. So most advisors will have to tell you that they can give you guidance on the type of investments that are being offered and the style of them. But as far as this, you choose this one, or this one, they really can't give you a direct response on that. So a lot of times advisors talk to people about, maybe at the beginning, because it's not a large sum of money when you start, that picking one of the retirement date or target date funds, because that is made up of, they do the work for you pretty much. So you say, I'm going to retire in 50 years from now, so I'm going to pick something that's called 2070. Holy cow. And then, so it starts out aggressive because that's a long time away, and then we'll automatically get more conservative as it gets closer. Not that I would keep it, that entire time, but it's a set it and forget it type of thing, and you don't have to worry about the management of it, or what, should I be buying international versus US domestic stock or things like that. But yeah, it's very overwhelming for people to get that packet and not know. I think even here, this is what we do for a business, but unless you have licenses and designations and stuff like that, other people wouldn't know what that is. And so we have to try to give guidance without giving advice. We cannot give advice on that. And so that's where you're going to run into problems. And a lot of people ask their HR person, and they know just as much as you do.
Yeah. I mean, sometimes they may have a representative from the retirement plan that you could talk to that would help explain some of the things. They can't tell you which way is the best one for you, but they could tell you at least, okay, this is what this is, and maybe explain it in a little bit more plain English. And, maybe you're offered a traditional 401k, or you have the option for a Roth 401k or an after-tax 401k. They can probably explain those options to you, to at least so you know exactly what you're choosing, even if they can't give you the exact, this is the best route for you to go. So I'd say definitely reach out to ask your HR person who the retirement plan advisor or representative is, and give them a call.
And then there's always, if you happen to have, like my mother didn't go to any financial person, but a lot of our clients that are here, what we do is often talk to their kids that are going off to college or getting ready to graduate college, or at any stage really, and we're willing to help them at least understand what they're looking at. So if you have that ability, it wasn't something that was an option for me, but if somebody out there is lucky enough to have that ability to get some free advice, then I would use that. Do you have any other questions yet?
That was the first one, and thank you, because actually, Adam, what you shared about kind of getting in contact with if there's a representative, that was kind of what happened. It's happened actually, 2 of the jobs I've had. There was like a representative you could reach out to with questions, and they did exactly what you said. They didn't really tell me exactly what I was hoping, but they at least gave me some information, so I was making what I felt like a more informed decision.
Sure.
That's it. Wouldn't it be easier if somebody just said, do this, and you're like, okay.
Or even just here what I see is in their professional opinion, what were the pros and cons of each,
Mm-hmm.
That would be at least getting there. Again, it's kind of going more in the advice track, but that would be helpful. But
yeah, it is overwhelming when you start a new job and you get that packet of all the benefits, not even just the retirement stuff, but what health insurance plan, if you're lucky enough to have that offered to you, which one to choose, or if they have a cafeteria plan, which means that you can choose do you want them to give you money do you want to put away money towards a family, the dependent care plan, or
health
savings account? Yeah, there's a lot of different options. Or, what type of, some businesses give you an option of, what type of leave do you want and things. It gets very overwhelming. You don't even know the business, and you somehow have to talk to somebody about all these very important things that you have to decide in a short amount of time.
I would say that's the biggest issue, is not that there are too many choices. Within your retirement plan, you might have choices for investments, but when it comes to the overall human resources person giving you that benefits package, it's basically all the stuff that they offer.
Mm-hmm.
And it's choosing whether you want to be included, whether you want to take part in any of those things. That's the big question. And, right off the bat, you might not know, or if, can I still do this next year? Or, there's a lot of questions like that. A lot of those things the HR representative can help you with. I know some benefits include life insurance, things
Mm-hmm.
like that. It's a lot to think about, but really asking questions and trying to get as much information from whoever you can at your job is really a huge thing to do, because going in and trying to bluff your way through it, or just say, eeny, meeny, miny, mo, you might hurt yourself in the long run. It's just as much information as you can get, the better.
Yeah.
Thank you.
Try to enter any plan that you have access to.
Yeah.
All the time we get people in here that say, I really wish I had joined the New York State Deferred Comp Plan, and it was too late for them.
Yeah.
So do what you can.
So no other questions right now, but I'll just reiterate, if folks have questions, please chat them in. We want to make this as useful for you as we can, but I would say feel free to kind of go with the questions you have for now.
Okay, perfect. Well, I think we kind of covered the next one, which is, what retirement plan should I pick? There are so many to choose from.
Yeah.
And I think that we went over that, and the only thing that we probably didn't say is that there is no one size fits all, and that was pretty clear after we went through all of that. No one size fits all, so there's no correct answer. It's whatever fits you best and what you feel the most comfortable with. And when 401ks were originally thought of, the idea was that people were starting to work when they're 20, they're going to retire when back then 55, 60 years old. And then once they retire, they're never going to work again. So they're going to be in a lower tax bracket in theory. And so deferring money before taxes made a lot of sense. However, fast forward a couple of decades, and now we have a Roth 401k, because what happened was that people were working a very long time, and then even after they were done working, between pensions and Social Security or whatever income they have coming in, they ended up making as much, if not more, in retirement, and therefore deferring before taxes didn't end up working in their financial favor, and a Roth helped them tax-wise later on. So it's kind of confusing, but the idea is the thought process behind the 401k to begin with may not necessarily be the benefit that everybody was thinking about. And so doing after-tax contributions, the younger you are and the longer you plan to work, at least right now, because they'll be tax-free, kind of makes the most sense for people your age and our ages.
Yeah.
we both do Roth 401k.
Most of the data really shows us that if you have a long timeline until you need the money, if your retirement is quite a ways out and you're just starting out, that the tax benefit in the long run of receiving those withdrawals tax-free versus getting it reducing your taxable income right now when you're putting the money in, that later on in life, having it tax-free far outweighs the benefit now.
Yeah. All right. So next question that we had here was, how much should I plan to contribute to my retirement plan when I am a new hire?
Yeah, I think we talked about that a little bit, really trying to stick with, your daily life, making sure that you have the money you need to pay for your living expenses. and adjusting your contributions from there. And I mean, that's just when you're starting out, you're still trying to likely figure out, you may move to a different place. Maybe you're in a big city, lived in a small town before, maybe vice versa. Maybe you're adjusting to having a car for the first time. There's a lot of expenses that go along with that: car insurance, gas, upkeep. There's a lot of different things that are kind of in motion, and you need a little while at least to get adjusted to a rhythm and figure out what your pattern of expenses are, what your income is, and how the two of those work together, what's left over, or what you might need to make up with, maybe some other source of income possibly, or reduce your expenses even. But that doesn't mean that that's how it's always going to be. So, maybe you're offered a raise after a short period of time, or maybe there's somewhat of a structured pattern to increase your wages. That usually is a good time for people to think about increasing their retirement contribution, because if you can make do with what you're doing now and maybe you're comfortable, the extra raise that you would get, for most people, it would be absorbed somewhere. Maybe it's just extra trips to the store, or you're eating different kinds of food. The budget just kind of expands. So a lot of people choose to use that raise they would get to increase their retirement contribution percentage, just by maybe not all of it, but some of it. That's usually a good way to go forward. And then over time, you'll find yourself increasing your contribution, but by all means, you really want to make sure that your daily living expenses are taken care of.
Yeah. You won't miss that money if you're not currently spending it, and you instantly, any raise that you get, just say, okay, I'm going to increase my deferral. You're not going to miss it, but easier said than done.
Yes.
Yeah. What I try to do. Does it always happen?
No.
I try to do it. I'd say it happens probably more than half the time. When there's a raise, I increase my contribution. So. Well,
and the younger you are, the harder it is, right? Because you just said you have a 1-year-old. How old is your other child?
3.
3. Okay.
Yeah.
So
I have 2 in daycare right now.
Yeah.
Yeah. And diapers and everything else that goes along with small children, and
every penny.
And it might be that in your life you take 2 steps forward and then 1 back in terms of how your contributions or your forward savings look, because not everyone's progress is just working their way up in terms of making money and keeping their expenses the same. Yeah. Expenses when you have children obviously go up, so you have to be flexible.
I knew it was going to be, more expensive than my single or like my married without kids life, but I don't think I quite understood how much until you're in it. You're like, oh, wow, yeah, this is different.
All I can say is wait till sports kick in, and then it's unbelievable. But here's the good news, is that a lot of people feel guilty about not being able to set aside as much as you may think you should be at this stage. But the majority of people really can't afford to save serious money until their late 40s, 50s, and 60s. So the idea isn't that any advisor would expect you to be able to put away every single penny right now that you have for discretionary income, because there has to be a balance between living now and saving for later, right? You can't just save for tomorrow. What happens if there isn't a tomorrow? So you do still have to live for today, but when you get older, that's when you're going to really start wanting to put more money away. So there's no guilt right now. The idea is just to make it a part of your pattern. You said your savings pattern. So as long as it's a pattern for you, then it will become part of your lifestyle that you have to put money aside. The dollar amount does not matter right now. It could be $20 a month. Again, we are very aware of what's going on right now, so we are not saying that this is something somebody has to start today. The idea is when things are back to normal, I don't even know that there's such a thing anymore, but at that point, then you try to make it as part of your daily routine. No dollar amount, no guilt.
There's no magic number. There's people that say you should have a credit score of such and such. Yeah. Well, that doesn't really apply for people that can't pay their bills. So, each individual person's situation is unique. So, you have to work with what you've got. And, with saving, it's good to start. But like Christina said, you don't have to have a certain number. There is no hard and fast rule of any of it.
Yeah, absolutely.
Thank you.
No problem. All right, so you answered the should that go up over time. The next one is how much should I be saving? Well, I think that we have kind of beat the dead horse there with the basics covered. Again, food necessities are food, clothing, shelter, health insurance, which I know that a lot of young people in the past have thought that maybe it's not a necessity, but with what we're going through right now, I think it has become top of mind for most people. Transportation and being able to cover those debts. So that, get that stuff out of the way. And if you can move past that, then paying your everyday bills, telephone, which I think for most of us is a necessity if I were being honest, utilities, things like that. And then have to have some fun like Adam mentioned before, because again, you have to live today. Building up your emergency savings, and then I think that at that point, you can sit down and kind of figure out what you want to save.
Yeah, I think that's a good point that Christina just made about the emergency savings. When we say saving, we don't mean that you're throwing every extra penny you have into retirement savings. You should have a good amount of cash set aside. Hopefully you could pay for a while of your bills if you were out of work, which is really what's going on for a lot of people right now. And you want to make sure that you can pay some of your bills during that time if you can. There are also other means, if you really have to, credit cards are available. We want to see people use them responsibly, but there are situations when an emergency actually happens. You see people that say, I have this emergency credit card. Now for some people it's an emergency, but really, the idea over time is to develop a healthy pattern. There are going to be times when you need to adjust it and go out of the normal, but you want to try and get some cash saved up. If you need it, it just gives you a little cushion.
The rule of thumb is 3 to 6 months of expenses, not 3 to 6 months of income, which is overwhelming, but 3 to 6 months of expenses. And if you are really thinking about what we're faced with today, 6 months of expenses in your savings account would make you feel a little bit more comfortable because there's a good chance that we may not be back to where we should be after 3 months. I think that there's a greater chance of us not being back to work full time and everything in that amount of time. So 6 months of that, and then you can always set up a separate savings account for a large purchase, right? So Morgan, I don't know, do you own a home? Are you renting?
Yes, I own a home. Yeah.
And so you probably had to go through the whole process where you needed 20% down for your mortgage.
Yeah, that was a whole crash course too. I've actually bought 2 homes. So I bought one in 2014, and then I sold that one when I knew I was having a second child because first house was pretty small. And then the second house we bought right before we had our second child. So in 2018. Yeah. So
what the purpose behind that would be is to have your emergency savings and then separate out have a separate account with money set aside for a large purchase, whether it's a vehicle or a house or whatever it is that your goals are that are usually temporary or short-term in nature within the next, say, less than 5 years. You don't want that money invested because you don't know what the stock market's going to do over that 5-year time horizon. So you want to keep it pretty liquid in cash or CDs, things like that. But, have an idea what you want to buy and then start saving systematically for that. So if you know that you're going to buy a house and you want to buy a $100,000 house and you have to put 20% down, then that's $20,000 you have to have saved up.
Yeah, my wife and I, we kind of, like, as you said, we had that goal in mind, and what we basically did during that time period was anything extra we could kind of scrounge, we put it in our savings account, and then when the time came, which was hard to do, you write that, or I wasn't really writing a check, but the money got pulled from your account, and you're like, oh, gotta start over.
Yeah.
So that's the interesting part about it is once you start saving, it's almost that it's a satisfying, I don't want to use the term addiction because that's not a good word to use, but it's very satisfying to keep on having that, and you almost play a game with yourself. Okay, well, how much more can I get in there? Okay, how much more can I get in there now? But then when you have to actually go and use it, you kind of feel like now you don't want to give it up, that you're going to have separation anxiety.
Yeah.
So, that's the funny part about it, but you feel better, and you feel like, oh, I can do that. I can get to a higher number, but then, there is such a thing as too much too. So, try to have some balance. I think if there's anything else, just find balance in anything that you can do.
Yeah.
So do we see that there's possibly another question there?
Doesn't look like
No?
that
Okay.
right now.
Okay, just want to make sure. I thought I saw it blinking.
Yeah.
All right, so then the next question that we have here is, are there good budgeting apps or software that you can use to keep track of your spending?
Yeah, so I actually looked into a few of them. I've used a few over the years, and we talk with clients about some of these because there are people that really want something in the palm of their hand that can give them a quick glimpse of what they've looked at and spent, instead of sitting down on a computer and doing a spreadsheet necessarily. While a spreadsheet is still a viable option, I'm sure that a lot of you have experience with them. There might be a little bit easier and faster way to do it. There's a few apps just off the top of my head. There's Truebill, it's called, so Truebill. That's a free app. There's Mint, MINT, that's also free. And Clarity Money, CLARITY Money, that one is free as well. So there's one on here that is a pay-for app. It's called YNAB. It stands for You Need a Budget. And it's actually free for students for 12 months. So, as long as you're still a student up until you graduate, you can start your 12-month timeline if you wanted. But basically all of these, they look at the idea of a budget and you're tracking your spending in a little bit different ways. But the main theme is that you're keeping track of what you spend in certain areas. So you want to find out, okay, how much am I spending on transportation every month? How much is my living situation costing me, whether it's a mortgage or rent? How much am I spending on takeout? For a lot of people, that's one of the big things that they don't realize. You say, oh, well, I'm just going to grab some pizza tonight, and then by the time you're done, tax gets added to it, and then maybe you get it delivered. There's a delivery fee, there's tip. And what you thought originally in your head was, okay, maybe I'm spending 15 or 20 bucks. It ends up being a little bit more than that. But when you shuffle all of those things together over a month's period, or if you really want to look at it for a year, it really adds up. So it's a good way to make sure that in your mind, you know what you're spending and you don't just have a preconceived notion of it.
All right, I have a question.
Yeah.
So I have now, a full disclosure here, I have never used a budgeting app. Never. I am, what you said, the Excel spreadsheet person, and I am sad to admit that. But how much work goes into somebody using an app? How much do you have to do? Because I know you said you actually use one.
Yes. So really, you have to be comfortable with, which most people are now, giving out some of your personal information. So you're kind of giving up a little bit of your control online. You are linking bank accounts, credit card accounts, same thing that you might do at a site like Credit Karma to check your credit score. You have to link those things in order for it to give you, the accurate data. So what it's going to do is pull the information from your bank account, from your credit card, the transactions on there. Maybe if you have a utility bill or something, you could possibly have an online log and you enter all of them for these days.
So you don't have to enter, once you enter that original information and link it, then you don't have to go in and do anything.
You don't do any manual transactions. Okay. It should pull most everything. It's going to be the one-off things that, if you wrote someone a check for something and maybe they didn't cash it, for a long time, you might want to go in there and enter it manually until you see it come through on your bank statement. It's those types of things. But usually anything that passes through either a credit card or your bank account, unless you use a lot of cash, it's going to capture it.
All right, and what about safety? So when you look at those, is there a way to research the companies to see about their safety precautions that they have built in? Because that part would get me.
Most of them, they're available on the app stores, so you'll see that they have reviews. They also will list their security, encryption, things like that. They all have passwords, usernames, and there's the option on a lot of them for either the fingerprint or the Face ID on Apple. So it's pretty much the same security controls that your online bank account would have.
Okay.
So that was a concern I had too, and I actually use a budgeting app that I just started to use probably about a year ago.
What's the name of that?
It's EveryDollar.
Okay, I've heard of it.
So, but the way I set it up was I track every transaction on my phone. So I didn't put in like my credit card or bank information.
Sure.
But when I pull the card out or I write a check, I put it in the phone, and then it just tracks it through the month. And I will say, what was that?
So yours is a manual process?
Yeah, as far like what I do is basically I kind of chart out the month ahead of time, so I kind of know what my expenses are, and then as I make a transaction, like if I, like in my case, like when I pay for daycare, I put that week of daycare in, and it kind of deducts from that bulk amount I had, so I can see it in real time. And I think the seeing it for me was helpful to change my habits.
Sure.
Seeing it like, oh wow, last month you brought up takeout. Like last month I spent this much on takeout, so now probably a lot of the apps do the same thing, but the app I use, like, it allows you to, you could say, I want to spend $80 this month on takeout. So it kind of get a warning almost when you get close to that. Okay, well, you've spent it all.
Yep.
So either you are choosing to go over or you're done. And it was helpful for me to see and then realize, like, okay, well, we're only going to do takeout like once a week now.
It gets expensive. And I was just going to say, so you're definitely trying to live by a budget, and I've always associated budgeting with dieting. So this is awful for a financial planner to say, but I don't believe in budgeting, because just like with dieting, I feel like it means that you're going to go back to your normal habits afterwards versus making, right, exactly. Versus making permanent changes to something. So, personal information here, but I used to put about 5 packets of sugar in my tea each morning, and it was really bad for obvious reasons. And so instead of just kind of cutting back on that, I just went cold turkey, stopped the sugar, not even 1 packet, and I just substituted honey. And I've been doing that for probably 8 years. I don't even know that I've had sugar since you've been here. So yeah, I believe in making permanent changes versus just a budget or a diet for something.
Well, setting goals for your $100 a month category. But there's other people that are just really not realistic. Having an accurate picture and kind of not lying to yourself.
Right, and not feeling guilty.
Yeah.
Because I feel like, again, when somebody goes off of a diet, they have that guilt factor.
Yeah.
So, don't be guilty about it. You have to spend money where you have to spend money, and sometimes we need to splurge on ourselves because we deserve that. So that would be my comment on that. All right, so let's see. The next one is, I am considering buying my first car. Should I new, lease, or buy used?
So personally, I've done all 3 of those. So I like doing a lot of those numbers when I get to a dealership. Some people are really intimidated by it, but I like the numbers side. I don't necessarily like the sales stuff, but I like just analyzing what's going on and what's going to be the best deal for me. So, it really depends on your personal situation. Again, everyone is unique. It depends on what stage you're at in life. So if you find that maybe you're moving to a city and you're going to take public transportation for most of the time, it may not make sense to have a car at all. It also may not make sense to go out and buy a brand new car if you're not going to be driving it around very much inside the city. Maybe leasing an inexpensive car is probably the best way to go because you're not going to put on a lot of miles. So the difference between buying a car and leasing is where, think of a lease is you are borrowing that car and you're paying the dealership to use it for a specified amount of miles and time. So a lot of them will say, okay, you have 10,000 miles per year for 3 years. That's kind of a standard lease. And they'll have written the contract, okay, this is how much the car is worth brand new if you were to buy it. This is how much the car is going to be worth when you're done borrowing it from us. And the nice thing about a lease is actually sometimes you can, at the end of the term, you can go back to the dealership and instead of turning it in, you could buy it. So if it's a good car and you like it, it's, you don't really want to roll the dice on getting a different car. And for a lot of people, if they don't put on a lot of miles, a lease is an inexpensive way to use a car. And you can also buy it out afterwards if you have a lot of confidence that it's going to be good for the foreseeable future. And sometimes you make out really well in that case because you'll have, say they predicted that you're going to drive 10,000 miles per year. And this is what the price was when you negotiated the lease at the beginning, or the price they gave you. Say you're going to buy the car for $10,000 after the lease is done. That's assuming that you're driving up to the maximum that you were supposed to drive. If you drive less than that, you're actually getting a better deal, but that price is already locked in. So it's kind of, it really depends on your personal situation, how much you drive, how often you like to get new cars. In general, I would really discourage a lot of people from buying a car brand new, just because right when you drive the car off the lot, you're going to lose a lot of value on the car. Sometimes there are exceptions to that when, say, a dealership is trying to put out their new stock of cars for the next new year. They have brand new cars. A lot of times they have the previous model year that they'll give you big discounts on, even though it's technically a brand new car, it's still a year old. So you could probably get a better deal on one of those. Getting a used car is also a really good deal, depending on the quality of the car and the shape that it's in. If you're getting it from a dealership, most of the time they'll have, certified used cars or things like that, depending on your budget. But if you're going to go find a used car from someone in an ad, a private person, probably go check it out with someone that has some mechanical know-how so they can kind of take a look at it for you so it's not going to break down half a mile down the road. But it really depends on how much you're going to drive. If you have to drive a lot, you're really going to want a dependable car. So, maybe getting a used car more towards the newer side or even towards that new car. Or if you don't drive very much, maybe a lease might work great for you. It depends on your budget and, how much you're going to be using that car.
So for me personally, I tend to buy new because I like to buy and keep it for a long time. And I'm usually looking for the deals of 0% financing. And we call that leveraging your money because it's not costing you anything to carry that debt, and I can be using that money somewhere else. So, I take out the loan for the 0%. And that seems to get me a better bang for my buck because I'm going to probably keep my car close to 10 years. And I put a lot of miles on my vehicles because we travel all over for sports. So for me, that works. But used or leasing.
Yeah, well, and a lot of the time, the 0% financing deals out there seem fantastic. It's like, oh my God, that's, free money. But you might also be looking at a $35,000 car, and it doesn't really matter how you work the numbers. Yeah. It's still an expensive car when you make that monthly payment.
Yeah, affordability.
Yeah, whereas a car half that expensive, even if it might be a similar quality, it's just a few years old possibly. You run the numbers, you really need to see what's affordable for you. Just because it says 0% doesn't mean it's going to be a great deal every time for you specifically.
Yeah, absolutely. Know what you're getting into on that one.
We did have a quick question actually come in. It's kind of related to what we were talking about previously. I think kind of managing debt. Peter asked, when it comes to debt, do you prefer the snowball method or the avalanche method?
I have heard of that. I've heard those terms. So how we prefer to prioritize debt is look at the highest interest rates first and pay the minimum on everything else that you can, and put as much money as you can on the highest interest rate ones first. So I believe that that's the avalanche.
Yeah.
Okay, I thought so. I've only heard the term once or twice before, so I couldn't remember it. But it costs you less in the long term to pay off the highest interest ones first. However, from a mindset, which is very important for people to consider, some people prefer to keep on paying as much as they can on all of them, so they feel like they're making some headway across the board. So, if you need that to mentally, get through what you're doing, then nothing wrong with that. But the correct financial way to do it is to concentrate on the highest interest rate payments first, and still continue to pay your minimums on the other stuff. Don't forget to do that.
Yeah. Because if you think about a credit card, the average interest rate is probably around 20%. If you're looking at that and you have $1,000 on that credit card that you need to pay off, 20% of $1,000, pretty good amount of money. That's what you're going to pay over a year in just interest. So if you think about it that way, and it might be your smallest amount you have due for debt. So you have another bill that's $2,000, but the interest rate is only 10. You're looking at two different things that are actually the same when it comes to numbers. So even though paying one off in that instance is the same as the other, you're not going to run into many situations like that. A lot of the time you're going to say, okay, this is my smallest amount I have. I want to pay it off just so I can have that little victory. But you may not have the lowest interest rate. You may have something over on the side that you don't really think about it because it's kind of middle of the pack. Like, trust me, I've had my fair share of student loans. They all have different interest rates most of the time. So some of them can kind of get lost. You just get lost in the monthly payments. And really taking a look at those interest rates, it helps out a ton.
Yeah.
Great, thank
Hopefully
you.
that answered your question. Avalanche. All right. The last official question that we have, it looks like, student loans will be a big part of my finances for the foreseeable future, which kind of goes into what you were just saying.
Yeah.
What financial goals should I prioritize with my remaining funds? So I think that's a great question, because it kind of puts everything in a nice little bow on it that we have talked about so far. So again, if you haven't heard us say it yet, basic living expenses, and I don't have to list those for you, but you have to know what you need to support yourself. Then your emergency savings, at least 3 to 6 months, and I try to push people towards the 6 months of emergency savings. Then your large future purchases separate account, and then retirement savings, and then fund money. That's kind of how I would prioritize what you should do with your funds. Would you have any?
Just kind of to expand on it a little bit, just a different look. My wife and me, we bought our house about 8 years ago now. And, you kind of, when you buy a house, it may not be the house that you really want for yourself in the long run. It may be a starter house, or it may be something that you say, if I put a little bit of work into this and do some projects along the way, renovations, maybe it'll be the house that I want, or it's, somewhat of an investment to some. But some of that fun money, or some of the large purchases, those could be renovations, or those could be, some people, maybe they rent and they don't have any plans on buying a house. Maybe big trips every year or something of that nature could be that kind of bucket of money.
We call it a goals account, just whatever that goal is for you.
Yeah, and for some, they are comfortable paying the minimum on their student loans and saying, I know I'm going to pay this for 20 years. Maybe they have a really good bunch of loans and their fixed interest rate, which I would really try to recommend for a lot of people. But even so, right now, interest rates are low. So, not the biggest deal, but some choose to accelerate their payments. with that extra money. You know, you might say, hey, you know what, instead of 20 years, if I chip in an extra X amount of dollars every month, I could pay this off in 16. You know, so really, that's another option as well. It really depends on how much debt you want to carry and for how long, and what your other plans are. Because everybody has different priorities, but really trying to make sure that you're healthy and happy, and you have money for everything that you would like potentially. You know, everything in balance, like Christina said.
So Morgan, I don't know how much time we have left.
It's close to 6. If you have more you want to share, certainly feel free.
Okay, we just want to be mindful of everybody's time, but I didn't know if we should briefly touch on the impact of the CARES Act on the student loans.
Yeah, I think that would be valuable for folks. Yeah.
Okay. So we're not sure if everybody is keeping up on all of the information that is out there. I mean, we are constantly getting bombarded with new information every day, so I can't imagine what you guys have coming through to you. But we did do a little bit of research on some of the new changes with the CARES Act for student loans. So good news with that is that no payments are required on federal loans owned by the U.S. Department of Education between March 13th, which was last month, and September 30th. And during that time, interest rates will also be 0%. But again, the caveat there is that it has to be loans that are still owned by the U.S. Department of Education. So if you have a private loan, either through your school, which would be Plattsburgh State in this case, or through a bank, or even some Perkins loans, those would not be subject to the 0% or the payment deferral time. And I believe that, Adam, you said that they just stopped all automatic.
Yes. Those, the federal loans that are included, they automatically take care of them. So I actually had one of them, and they stopped it, and they just sent me a letter, and they automatically stopped payment and said, you will be charged 0 interest for this period of 6 months, and we won't take your amount out of your bank, even though it's set up direct deposit. But if anyone actually wants to make extra payments, you have to go in there and do it manually. So that might not be the case for a lot of people, but anyone that wanted to kind of get ahead and pay just down on the principal, they have to do it by themselves manually. But really, they are trying to make sure that they take care of the federal loans with the Department of Education. The other private loans and the other loans that don't qualify, that may be a federal agency and not exactly Department of Education, those ones are still ongoing. But if anyone wants to talk about a forbearance or anything like that, or work with the loan provider, they should call their loan company and tell them that they're having difficulty due to the COVID-19, if they're being affected, to see if they can come up with a different payment plan, reduce their payments or postpone them for a period of time. So they're really, all the servicers, even if it's not the Federal Department of Education, they're really trying to work with all the student loan borrowers out there.
And I should have added that also includes PLUS loans that are owned by the U.S. Department of Education. So if your parents have loans out for you in order to help you pay for college, then they will also have that 0% from now until September 30th, and the no payments are required during that time as well. So that's a pretty, I honestly, I don't think that I've seen that benefit before. That is really, that's impactful. So hopefully somebody can take advantage of that. Go ahead.
Just to add too, because I know we had talked about like the Plattsburgh.
Yes, did you get information?
I did get a bit of information. They shared, the financial aid office shared some information that was Plattsburgh specific. It really got into the weeds. So what I would recommend is if students, if you particularly have questions about, your loans or anything like that, just know that the financial aid office continues to work and help you out even after you graduate. So you may have questions about, whether it's notices you get in the mail or email about your first loan payments and things like that, or specific things related to the CARES Act. I would encourage you to reach out to the financial aid office on campus. Their email is, if you start typing financial aid in the, through your campus email, it'll automatically add in their email address. You can reach right out to them. And I would encourage you to do that.
Oh, that's good.
Yeah.
Okay. And then the CARES Act in general, I think a lot of people are wondering if they qualify for that $1,200 check. And the part to remember there is that if you can be claimed on anybody's tax return, so typically your parents' tax return, then you would not qualify for that $1,200 check. And so, that would be nice if you can, but a lot of kids are still on their parents' tax return. I'll probably be claiming my kids for years.
Yeah. One of the other things to consider is that, some of you may have part-time jobs. So it would be worthwhile to see if, maybe you had a part-time job and it was shut down. If you do qualify for some sort of unemployment, or if you had a work-study job on campus, I would talk to the university and see if there is any payments that you are entitled to receive, or if there are alternate employment things that you can do to still earn your paycheck without necessarily doing the same job.
Yeah, unemployment, that was a big impact from the CARES Act as well. You have the ability to get up to $600 more additional a week than you would normally under unemployment. And for 26 weeks?
Yes.
26
They
weeks?
doubled the amount of time that people can get.
It's normally 13 weeks, so this time it's 26 weeks, which they've done in the past when we've hit areas of economic volatility. We'll go with. And then just as a quick reminder is if you're 26 or under, if possible, try to stay on your parents' health insurance because then that's less out of your pocket right now, and having to cover yourself through this, it's kind of overwhelming. So try to stay on their health insurance for as long as possible, if they allow you to. Although,
yeah. And that's also one thing to consider if you're going out and looking for jobs, and maybe they offer health insurance, but you already have health insurance through your parents. Just because they offer it doesn't mean that you have to take it. If you're on your parents' insurance and everything is good with that situation, and they're comfortable keeping you on, you're fine doing it. You may be able to talk to your employer and say, I don't need the insurance now. Is there any additional pay incentive for not taking the health insurance? So having that ability to stay on there till you're 26, it's a really good thing.
So if anybody has any last minute questions, we would be happy to answer them. Hopefully some of this was helpful, interesting, or not too much in the weeds, because anything in financial or health related, I feel like it's very easy to get lost in the amount of information out there.
I don't see any questions, but I think a good thing to maybe end on, and it's a question I kind of have kind of on behalf of students. So, I guess students may be going away or are already back at home. If they wanted to try to connect with someone who does the work that you do, is there a good resource or a good way to find in their home communities, like folks who do the work that you do?
So I think the first place that people really tend to look is with their friends. If you happen to have somebody that's working with an advisor, word of mouth is definitely the best way to find an advisor. But if you don't have that ability, then doing some research. We usually recommend the Certified Financial Planners website because it's comparable to when you're looking at a tax person, and there's a tax advisor and then there's a CPA who's a certified public accountant. You just know that there's additional education involved in very rigorous education requirements. And we are constantly having to keep ourselves up to date on what's out there, and we have to follow certain ethical rules that may not be other people may not be subjected to.
Yeah, they may not be held to the standard of a fiduciary.
Yeah.
We have a fiduciary responsibility as a certified financial planner. So that's a good source to go. I believe it's cfp.net.
Yes.
And you can find one in your area. But basically, a fiduciary means that they must do what's in your best interest at all times. So, they're not going to try to sell something that's not appropriate for you, or maybe it's okay for you, but they would make more money on something else. A fiduciary is not allowed to do that. So really, you want to do a little bit of research, maybe just a Google search in your area.
Or broker check.
Yeah, there's a FINRA.org. It's the Financial Industry Regulatory Authority. You can track down anyone that's in your area. You can type in a name, and it can tell you if they have any indiscretions, if they have, dings on their report from complaints, anything like that, where they're licensed.
Full disclosure, we have none.
Yes. So basically, doing a little bit of research can help you, and can help you find someone that you feel is going to do a good job for you, that you think is knowledgeable. But it doesn't hurt to do research, to even call people up. It doesn't hurt. There's no obligation that you're getting yourself into.
And always go with your gut. If you don't have a good feeling, don't bother engaging. It has to be you're going to be sharing a lot of personal information with this person, so make sure that you actually like them as a person.
And another bit of advice, since you mentioned that, they should be asking you a lot of questions. So whenever you go talk to someone, it should not be them talking at you. So even though that we kind of did that to you today, the person that you go talk to should be asking you a lot of questions. You should be giving them a lot of information. That's their job, is to know a lot about you before they can even try to find out and recommend to you what would be a good investment, or a savings plan, anything like that. So really find someone that you're comfortable doing that with, someone that feels good to you, because there could be 10 people with the same credentials. You still want to be able to go and have a nice rapport with someone, be comfortable talking to them, like them. So, all of those things that you would find with any other professional, like a doctor or an attorney, you want to have a good relationship.
It is easy to research people now.
Yep.
Anything else that we can answer, Morgan?
No, I think that's a good place to leave it for the evening. But I do want to thank you both for your time and answering our questions. I feel like I learned stuff even just listening to you all, so I'm sure our students did as well. And thank you again. As I said, I'll follow up with a link to the video, and I'll also try to get you a transcription. You said that you needed that as well, right?
Yeah.
So I'll work to get that for you as well. I should have that hopefully by tomorrow.
Oh, no rush.
Okay.
Thank you. We appreciate it.
Yeah.
Goodbye, everyone. Stay healthy and good luck out there.
Thank you.
Thanks for having us.
We'll close on how we started here. We'll go out on a good note.
Ocean's 11. Okay, got it.
So now you all need to go watch Ocean's 11 to hear the soundtrack.
Sounds good. Thank you.
Thank you. Have a good day.